Hello, this is Dr. Nunez. Welcome to the Chapter 15 problem solving session. So these are the exercises that I've assigned for Chapter 15. Let's get started. BE 15-4, product and period costs. So what we learned in the lecture was that the product costs include three categories: the direct materials, the direct labor, and the factory overhead. Period costs, well, those are the selling and administrative costs. So what we need to be able to do is classify these costs for a magazine publisher. So we've got a magazine publisher. The first thing we've got is sales salaries. Sales salaries. Well, that is not at all related to manufacturing. So sales salaries is going to be a period cost. And then we've got paper used in the magazines. Paper used in the magazines. So again, what you need to be able to think about here for all of these costs is, are they related to manufacturing or not? If they're related to manufacturing, then they are either a product cost and they would therefore be direct materials, direct labor, or factory overhead. So if it's paper used in the magazines, well, that's the product. The product is the magazines that they're publishing, and the paper, well, that's going to be a product cost, right? Most likely direct materials. So here we're looking at a product cost because it's probably going to be the direct materials that are used to manufacture that product. And then we've got depreciation expense on the corporate headquarters. Depreciation expense on the corporate headquarters. Well, corporate's not related to manufacturing. That's going to be a period cost, right? It's selling and administration, more appropriately, an administration cost. So again, not related to manufacture. It's going to be a period cost. And then maintenance on the printing machines. Well, printing machines are going to be used to manufacture the product. So we're looking at a product cost, right? We're looking at a product cost. So again, if we have a cost that's related to manufacture of what? In this case, a magazine, it's going to be a product cost, like the paper. That's going to be materials. The maintenance on those machines, that's going to be overhead, but still a product cost, right? And then you've got some non-manufacturing costs like sales, salaries, and corporate headquarters. And that's going to be all we need for BE 15-4. Okay. Next, let's look at 15-1. So again, we're classifying these costs, classifying costs now as either materials, labor, or factory overhead. So now we've got costs that are manufacturing costs, and we need to classify them as one of the three different kinds of manufacturing costs. They're either going to be, again, direct materials, direct labor, or factory overhead. What's the difference? Materials costs they are materials related costs that are integral or key, and we can trace them to the cost object. Direct labor is touch labor. Factory overhead, well, it's not direct materials, it's not direct labor, it's other costs that are related to manufacturing. Okay, so the first thing we've got here, we've got the motorcycle engine. This is a motorcycle manufacturer. They're manufacturing motorcycles. Well, the engine in the motorcycle, that's going to be a direct material, right? That's going to be something that you can and you would certainly want to trace to that product. Next, we've got depreciation on the robotic assembly line equipment. Depreciation. Well, it's depreciation on the equipment. It's not direct materials. It's not direct labor. Definitely related to manufacturing, right? Because it's on the assembly line, but it's not direct materials and it's not direct labor. It's going to be factory overhead. And then we've got C, we've got the brake pads. So we've got the brake pads that are going to be used on the motorcycle. Well, that's going to be a material that you can trace to the motorcycle. That's going to be a direct material. The brake pads are going to be traceable to that cost object, that motorcycle. And then D, we're going to have glass for the windshield. Well, that's going to be a significant or an integral cost that you can and should be able to trace. The glass for the windshield is also going to be a direct material. And then you've got tires for the motorcycle. Well, again, you've got some materials that are going to be traceable to that cost object. It's going to be a direct material. And then next in F, we've got the salary of the quality control supervisor. The salary of the quality control supervisor. So quality control it's in the manufacturing plant, right? They're involved in manufacturing, but the quality control inspector is not touch labor, right? They're there testing and supervising the quality, inspecting, but they're not assembling the product. They're not touching the product during that manufacturing process. So it's not direct materials, it's not direct labor. That is factory overhead. And then we've got a motorcycle seat. Well, the actual seat on the motorcycle. Well, the seat on the motorcycle is kind of like the brake pads and the windshield and the engine. That's a key or an integral material that you can and should be able to trace. And then we've got some safety helmets that are being used in this case by the assembly line workers. Safety helmets. Well, the cost of the safety helmets is not something that you can trace to the motorcycle. It's related to manufacturing, but only indirectly. So that's one of those things that you would call factory overhead. And then the last thing, you've got the assembly line workers. So assembly, they are engaged in assembling the product. That is that touch labor that we refer to as direct labor. Okay? So just very quickly, one more time, those materials that we can trace and choose to trace, they're key, they're integral. The engine is a direct material. Those costs for items that are not direct materials, not direct labor, we can't trace them. They're indirect. We know that they are incurred during the manufacturing process, but they're indirect. The depreciation on equipment, that's overhead. And again, those direct materials that we can trace, we choose to trace, brake pads, glass for the windshield, the tires, and then again, more costs that are related to manufacturing, but we can't trace them. And we probably wouldn't want to if we could. The quality control inspector, the salary of the inspector, more direct materials, the motorcycle seat, the more overhead, the safety helmets and the masks the assembly line workers use, and then finally the wages of the assembly line workers, that direct labor. Okay, next. Again, we need to classify as product or period. Product or period. So in this case, again, you want to think of it in terms of product costs are related to manufacturing, period costs are not related to manufacturing. So if you've got the CFO, the Chief Financial Officer, that is in no way related to manufacturing. That is a period cost. You got sales commissions. That is in no way related to manufacturing. That is a period cost. And then you've got property taxes on the factory building. Well, it's kind of self-explanatory here. Factory building, that's got to be a product cost. It is related to manufacturing. So we would call that a product cost. If I could get that here. There we go. Depreciation on the sewing machines. So you have an apparel manufacturer, Abercrombie and Fitch. So they have sewing machines that they use to make the product. Well, that's manufacturing equipment. It's a product cost. Fabric that's used during production. Well, those are materials. That's a product cost. And then you've got utility costs for the office building, the office building. Well, the office, again, that's selling and administrative. That is a period cost, not related to manufacturing. And you've got factory supervisors. Well, again, what's key is it's in the factory, right? They're supervising in the factory. That is a product cost. You've got depreciation on office equipment. So again, it's in the office, not in the plant, not in the factory, but in the office. That is a period cost. And then you've got oil that is used to lubricate the sewing machines. Well, the sewing machines are used in manufacturing the product. That is going to be a product cost. And then you've got some advertising expenses. Advertising, never related to manufacturing. That is a period cost. And then you've got some research and development costs. Well, that's not direct materials, it's not direct labor, and it's not manufacturing overhead. That is a period cost. And then you've got these, get back to these sewing machines. Well, you've got some repairs and maintenance on the sewing machine. Well, the machines are used in manufacturing the product, so that's going to be a product cost. And then you've got salaries of the production quality control supervisors. So again, the quality control supervisors are in manufacturing, so that is going to be a product cost. And I think we've got here just a few more on the next page, salaries of the distribution center personnel. Now, let me explain here again. Any costs that are incurred during manufacturing the product are going to be product costs. Costs that are incurred after the product is manufactured, those are going to be period costs. Distribution center personnel, well, you don't have the distribution center personnel until you've finished manufacturing the product. So once you complete the manufacture, right, production's finished, you take those goods and you move them to the distribution center, to the warehouse, right? That's what this is, right? You've got the distribution center and the people that work in the distribution center. They get the product after it's finished. After they've added the materials, they've added the labor, they've added the overhead, the product's finished. It goes to the distribution center. Any costs you incur in the distribution center are period costs. They are not costs incurred during production. So they are period costs. And then you've got some travel costs for media relations. Well, it's media relations. It's not manufacturing or production. It's a period cost. And then you've got some janitorial supplies that are used in the factory. Well, if it's in the factory, those are going to be product costs. And then you've got wages of the sewing machine operators, that touch labor. They're touching the product while they sew it and assemble it. Those are going to be product costs. So again, the way we want to think about these is you want to think about whether or not the cost is related to manufacturing. If it is in any way related to manufacturing, a cost that you incur during the manufacture of the product, it's a product cost. If it's a cost that you incur after you have manufactured the product or outside of manufacturing, then it is a period cost, like the distribution center personnel or the media relations employee. Those are period costs. They're not incurred during manufacturing, right? Costs incurred during manufacturing are going to be product cost. Okay. Now, let's spend some time looking at cost accumulation. Focus on materials here. So when we determine the cost of the materials, that exercise that we looked at the end of the lecture for chapter 15, we started out by looking at materials. So you want to focus on one, what you start with, all right? You start with some kind of beginning inventory, and then you add something in that gives you what's available. Subtract what you have at the end of the period, and that will give you what you've used, the cost of what you've used, those direct materials used. So, and we're given everything we need here, right? We've got the beginning inventory. We know what we purchased. So it's the beginning plus what you've purchased is what's available. Subtract what you have at the end. And that's going to give you the direct materials, the cost of those direct materials. So let me see if I can get this here so we can talk about it. Here we are. And let me see if I can improve the formatting just a little bit here. Okay, so let's see if we can switch here to a pencil. Okay. So, oh, no, that's not gonna work. Let me okay, I think that's good enough. We'll go with that. So, what we've got here is we've got the materials at the beginning of September, 235,200. And then we buy some materials, right? We've got to purchase. And when you take the beginning inventory plus what you've purchased, that leaves you with the cost of the materials that are available. So essentially, they started with 235,200. They purchased $815,900 worth of materials. That means during the period, they had materials available that cost $1,051,100. And they get to the end of the period, they take a physical inventory, and what they've determined is, well, there's only 203,000 left. So they had $1,051,100 available, but there's only 203,000 left. Where are the rest? Well, they were used. And that's what we need here. We need to determine the cost of materials used. So the beginning plus what you purchased gives you what's available, subtract the ending, and that gives you what was used, 848,100. So we've got the cost of those materials that were used during the period, $848,100. Okay. So again, you want to think about this in terms of, an average inventory account. Anytime you're looking at inventory, whether it's materials, work in process, or finished goods, this is the approach you want to take. It's some kind of a beginning inventory, plus what you add in gives you what's available. Subtract the ending, and you've got what you've used, whether it's materials used or whether it's cost of goods manufactured or whether it's the cost of goods sold. It gives you the cost of what was used during the period. Okay? Next, let's take a look at the cost of goods manufactured in exercise 1513. So now what we need to be able to do is determine that cost of goods manufactured, the cost of goods manufactured. So let's work this through one piece at a time here. So again, the focus here is on the work in process inventory account. And you want to think about it in the way you think about any inventory account. You start with something, right? There's some kind of a beginning inventory, and it's the beginning work in process, 430,400. So we have this 430,400, and we're going to start with that. And then what we've got is something that we're adding in. What are we adding in? Well, we're adding in three things. All of the product costs, the manufacturing costs. We're adding in the materials, the labor, and we're adding in overhead. And they're all given. The materials are here, right? So if I could just here highlight those. We've got the materials here, we've got the labor here, and we've got the overhead here. Those are the three things that we are adding in: materials, labor, and overhead. So that's all we're going to do. We're going to take that beginning balance and we're going to add in the cost of the materials, the labor, and the overhead. So the cost of the materials, the labor, and the overhead. So here's what we've got here. We've got the materials, the labor, and we've got the overhead, right? We're just adding in those three things: the materials, the labor, and the overhead. And you put those pieces in, and what you have is, I'm going to put in a subtotal of those: the materials, the labor, and the overhead. Add those three pieces, and the net of those three pieces is the 66084. So that's all the materials, the labor, and the overhead. Add those three, and that's what we get. So let me put in just a little bit of a note here, right? We're going to take this plus this plus this is going to give us all the costs that we've added, right? So the beginning balance plus what we've added in, that's what we've done. Well, that's going to give us what's available, right? And we call that, we don't call it what's available, but what we call it is the total manufacturing costs, right? It's the total of everything that we have in that work in process account. So right here, the total of what we have here, the total manufacturing costs. So when we add what we started with in January, on January 1, plus the manufacturing costs, put these two pieces together, those are all the manufacturing costs, right? The 430, 400, and the 6608, 400. Those are all of the manufacturing costs. That's everything that essentially is available during the period. And now all we're going to do is subtract what we have at the end. And that will leave us with the cost of goods manufactured. It will leave us with the cost of goods manufactured. So see if I can just highlight this a little bit. So, right, this plus this gives us everything that's available, all those manufacturing costs. And then we just subtract the work in process at the end of the period, and that leaves us with the cost of goods manufactured, the cost of those goods that we've manufactured. So when we look at an inventory account again, our focus is on what we start with at the beginning of the period. We add something in, that gives us what's available, subtract what we have at the end of the period, and that gives us the cost of what we've used. The cost, in this case, the cost of those goods manufactured. The cost of those goods manufactured. Okay, we've got a couple more left, or I think actually we've got one more left, and we need to find several things here. We need the cost of goods sold, the profit margin, and the net income. So basically what we need is everything that you would find on the income statement. So let's see, the first thing that we need to be able to determine here is the cost of goods sold. We need the cost of goods sold. So the way we get the cost of goods sold is we focus on that finished goods account. The finished goods account. So we want to think about this again. It's an inventory account. That means we have some kind of a beginning balance. It's right here, right? January 1. We're going to add in something. What are we going to add in? Cost of goods manufactured. That gives us what's available. Subtract what we have at the end, and that'll give us the cost of goods sold. The cost of goods sold. So let me see if I can just put all of that up here, and then we'll talk about it a little bit. So here's what we have. Okay, so let me see if I can get my little pencil here. So what we've got here is we start with something, right? We start with a beginning balance. And that beginning balance in January 1, we add something to it. We add the cost of goods manufactured. And what that leaves us with is what's available, right? The 5,370,000. So we start with something, we add in the cost of goods manufactured. It gives us everything that's available, all of those goods that are available for sale. And then all we want to do is subtract out that ending balance. And what we're left with is the cost of goods sold. So we have the cost of goods sold. That's the first thing we need, right? A is just the cost of goods sold. The cost of goods sold, beginning finished goods plus cost of goods manufactured, subtract the ending, and we've got the cost of goods sold. That's fine because we need that on this income statement now in order to be able to calculate the gross profit. The gross profit is sales minus cost of goods sold. That's all it is. It's just the sales revenue minus the cost of goods sold. So in B, we're going to take that sales revenue that we're given, right, of 6.6 million, and we're going to subtract the cost of goods sold that we just calculated. So the sales minus the cost of goods sold will give us what we need. Sales minus cost of goods sold. So very simply, we have total sales revenue on the income statement of 6.6 million, and then we're just going to subtract the cost of goods sold, right? Sales minus cost of goods sold gives us that gross profit. That gross profit in this case of $2,005,000. $2,005,000. Let me just see. I'm blocking the numbers here, so let me just clean that up just a little bit. So the $2,005,000 is this cost of goods sold number. Cost of goods sold is the 4,595,000, and the gross profit is the 2,005,000. So we've calculated the cost of goods sold. We've calculated the gross profit. Next thing we need is income. Well, income is just gross profit minus the selling and admin, right? The selling and admin. So on that income statement, right, you have sales less cost of goods sold gives you gross profit. And then gross profit less selling and admin gives you income. So that's all we need. We just need the gross profit minus the selling and admin, and that will give us income. So all we're doing is the income statement in pieces, right? Instead of just doing the income statement in one step, we're doing the income statement in 3 steps. So again, we take that gross profit number, right, from part B, and we want to be able to subtract out the selling and admin. So let me see if I could just kind of sales less the selling and admin will leave us with the net income. And I've got kind of a subtotal in here. So let me move that over a little bit, and that should give us what we need. Right. Okay. So let me see if I can use my pencil here. The gross profit, right, of 2,005,000, that's from part B. We want to subtract the selling and admin, right? And I've got a subtotal in here for the selling and admin expenses, right? The 530 and the 340 gives us a subtotal of those operating expenses. So the gross profit minus these operating expenses will give us that net income number, that 1,135,000. Okay, so we've done this income statement in 3 steps. Again, instead of using one step to prepare one income statement, we spread it out a little bit and did it over 3 steps. And that's it. So hopefully, the illustration of these exercises will assist you in completing the application assignment for Chapter 15 in Cengage, and the quiz for Chapter 15 in Cengage. That's it. I'll see you in Chapter 16.